Today, I want to introduce to you guys 4 stocks that you can buy right now to start getting paid dividends every single month of the year. As those of you guys that have been watching my channel knows, I highly recommend that you guys just buy and hold the S&P 500 index, as I am doing in my $100 to $10,000 series. But for those of you that want to research companies in depth and build your own portfolio because you think just buying an index fund is boring, and if you want to try beating the market, these 4 companies are considered by most investors to be solid, blue chip companies that you should consider adding to your portfolio. And all 4 companies are mega cap companies with market valuations over $200 billion, so they are included in the S&P 500 index. The first company is Apple, trading under ticker symbol AAPL. Apple pays dividends on a quarterly basis in the months of February, May, August, and November. I am sure that all of you know what kind of a company Apple is. They make and design smartphones, personal computers, tablets, wearables. They have their own credit card, a game subscription service called Apple Arcade, and a cashless payment service that a lot of stores accept these days called Apple Pay. And recently, Apple announced that they will end their partnership with Intel, which has been supplying their chips used in the MacBook laptops. And so this company is always innovating and constantly looking for ways to make their products better and more competitive in terms of price and technology. And so Apple stock has been on a tear, even though in the early days of the pandemic in February, the stock did fall significantly as the company's manufacturing and its physical retail stores were impacted by public health measures. But it was able to rebound, hitting all-time highs and reaching a market cap of over $1.5 trillion in recent weeks. Total sales of its products and services in the second quarter of 2020 increased by 1%, or $298 million compared to the same quarter in 2019, led by a growing services and wearables sector, which includes products like AirPods and the Apple Watch, despite falling iPhone sales. Right now, Apple pays $3.28 for every share of Apple that you own each year, and it has a healthy payout ratio of 26%. Which means that the dividends paid out to shareholders is only 26% of the net income of the company. And Apple has been steadily raising its dividend every year in the month of May like clockwork. And its dividend growth rate is also impressive, with an average annual growth rate of 10% over a 5-year period. For those of you that are looking to buy stocks as a form of income, it's very difficult if you have a normal job to increase your salary by an average of 10% each year. But Apple is managing to do this because of their continued success in their products, as mentioned earlier. The second stock on the list is Visa, trading under ticker symbol V. Visa pays dividends in the months of March, June, September, and December. Visa is a payments tech company and profits by taking care of money transfers and information transfers between consumers and merchants, and operates in over 200 countries. Visa has not yet fully recovered from its February highs because of the fall in consumer spending, and Visa's revenues are directly linked with economic conditions and consumer spending. In 2019, Visa reported double-digit growth in both its domestic and international businesses, which is impressive considering Visa is already a mega-cap stock valued at over $400 billion. Although Visa has pulled its guidance for this year, analysts have been forecasting that earnings will rise 15% in their year 2021. And according to the Global Payments Report from McKinsey in 2019, global payments revenue is expected to reach $2.7 trillion in 2023, with an average annual growth of 6%. Visa pays $1.20 every year for every share of Visa you own, and it also has a low payout ratio of 23.9%, which again shows that the dividend is probably not going anywhere anytime soon. The third stock I want to introduce is JPMorgan, trading under ticker symbol JPM. JPMorgan pays dividends in January, April, July, and October. Founded in 1799, JPMorgan is one of the biggest financial services companies worldwide, and so, along with other banks, were one of the harder hit companies by the COVID pandemic, because banks will do well if the economy is doing well, and do poorly if the economy is doing poorly. And looking at the most recent quarterly report, its ROE fell to 4% from 16% the year before. ROE stands for return on equity, and for banks, it is an indicator to show how profitable the bank is. On average, banks have an ROE of 11%, so JPM was doing very well before the pandemic. And CEO Jamie Dimon was quoted to have said dividends are a drop in the bucket relative to the amount of capital under the company. But the current payout ratio of JPMorgan is at 68%, which is not terrible, but not great. If the company continues to be affected by the COVID pandemic over the long term, the dividends may end up being affected in the future. And the stock price has been reflecting this risk in the business, with shares down to $90 levels from its $150 highs pre-COVID, and with the recent limits on share buybacks and dividend payments from the Fed mentioned in episode 9 of my $100 to $10,000 series. But despite the risk, right now the current PE ratio of JP Morgan is sitting at a very low level of 10, giving it a decent dividend yield of 3.89%. And assuming that the company makes a strong comeback next year, JP Morgan is a solid company worth looking into. So with these three stocks that I just talked about, you will receive a dividend every month if you guys invest in these companies. But I want to recommend one more stock that you guys may consider adding to your portfolio. The company is Microsoft, trading under ticker symbol MSFT. Like Apple, Microsoft pays dividends on the months of March, June, September, and December. Just a decade ago, Microsoft stock has been lagging the S&P 500. But with CEO Satya Nadella taking over in 2014, Microsoft has been outperforming the market at a neck-break pace through refocusing the company to the cloud with the launch of Microsoft Azure, which grew 59% in the most recent quarter compared to the year before. Microsoft stock did fall significantly, nearly giving up its gains in 6 months and just a few weeks in the early stages of the pandemic. But after showing that its business was quite resilient to a pandemic, with its cloud and Microsoft products becoming more popular, with remote work becoming universal, revenues rose 15% from the previous year, and the stock started to hit all-time highs again. And the cloud storage market is expected to grow at an annual rate of 23%, so Microsoft will continue to profit from this growing industry. And finally, to put the cherry on top, let's talk about the dividend. Microsoft currently pays an annual dividend of $2.04 for every share of Microsoft you own, and that gives you a yield of 1.04%, which is on the lower side, but considering how fast the stock has been going up, it's more than justifiable. And similar to Apple, Microsoft has managed to maintain an insanely high rate of dividend growth with over 13%, 10-year growth rate, and a healthy payout ratio of 35.84%. That's gonna do it for me this episode. Let me know down in the comments what you guys think about the 4 stocks that I discussed today.